Let's get the instant analysis now with Dana Peterson, the Conference Board Chief Economist. Dana, what happened here? What's going on?
Well, consumers are definitely less confident in August relative to a few months ago. Indeed, we saw the confidence measure downwardly revised in July, and we basically erased gains from the last 2 months. Consumers are more concerned about inflation. They complain about food prices, gasoline prices, inflation in general, and they also are less optimistic in terms of the labor market going forward.
So does that mean consumers aren't as confident that if they quit their job, Dana, that they'll be able to get a new one? Is that a fair reading?
I think that's accurate. And certainly when we look at the JOLTS data, we see that there are fewer job openings. So that means consumers are saying, look, there aren't as many options out there. Maybe I should start sitting tight, especially since wages are not rising as aggressively. And we're starting to hear a little bit more in terms of softer employment. So I think all those things together are making consumers a little bit less confident than they were certainly a few months ago.
I guess I'm just wondering kind of what changed, because none of the other data that we've gotten would necessarily mean everyone's really freaking out and tightening their belt. So put that into perspective for us.
Sure. What's different is certainly consumers are paying more for gasoline, and they are paying more for food. So those two things really put a damper on consumer finances, which were not as great as they have been in the survey, both currently and also looking ahead to the future. So that's definitely different. And also in the labor market data, we are going to get payrolls this month, but payrolls last month and also in revisions have been revised downward. And so consumers are hearing about this, and we think that they're getting more concerned. Also, consumers are probably concerned about what they're hearing in the stock market. Banking stocks are down because of downgrades, and maybe that's also feeding into the psyche. We didn't ask that question, but it certainly could be a factor.
Dana, you didn't mention this, but I gotta imagine mortgages also must feed into this. Past 7%, a housing market that feels essentially frozen. Do you see any feelings of limbo among consumers given the housing market?
I think so. And when we look at their expectations for interest rates, their expectations rose. So they think the Fed funds rate is going to be higher. They also think stock market gains are going to be lower. And certainly when we ask about housing, they're still saying we're not really planning on purchasing homes. So yes, mortgage rates probably are playing a big factor into how consumers think about the housing market. And we're seeing it evident in the housing market itself in terms of existing home sales down and very little action in new home sales.
Hey, Dana, I'm curious as to how this will affect savings rate. So do we imply that if there are concerns, the saving rate gets drawn down more and provides less of a cushion, or do we stop spending the savings altogether, and that sort of, you don't have that extra juice anymore for the economy? What do you think?
Well, when we look at excess savings, which is all the money that consumers received throughout the pandemic, it topped out at maybe $2.2 trillion in real terms after adjusting for inflation. In the last reading, in the second quarter, is around $730 billion. We think they're going to run out of that money this quarter. So definitely they're running out of options in terms of spending. They're looking at credit cards, and credit card debt has risen to $1 trillion, and we're back at pre-pandemic levels. And certainly when we look at delinquencies, those are also back at pre-pandemic levels. So consumers are headed for some trouble, we think.
Dana, there's this great report from the Brookings Institute basically saying that consumers are spending the same amount that they were just immediately post-pandemic, suggesting that the rate at which they run out of cash is likely to be higher, too, because of that level of spending. Has that level of spending, have you seen that maintain itself? And are we due for a really sharp drop-off because of that?
Well, when we look at spending in general, year on year, it's been slowing. Certainly, a lot of the spending that people are engaging in has shifted to services, but it's not as aggressive. And we do think that there will be cliffs here. Student loan repayments, at least on the interest, will probably come back in October. Like I said, the excess savings is going to run out now, and consumers are building up quite a bit of credit card debt that's going to be due at a higher interest rate. So we do think that consumer spending is going to be very weak and will contribute to a recession probably by the end of this year or early next year.